All right, good morning, everyone, and welcome to the February 2026 meeting for the Lextran Pension Committee. We will call the meeting to order and start with roll. Nikki Falkenberg.
Here.
Eric Watson.
Watkins.
Watkins. I apologize.
It's okay. It's been my entire life. Here.
Jason Dow.
Here.
Carrie Legg. I also like to mention that former committee member Todd Birch has resigned from the committee, and we do not have quorum to go over the minutes and approve the minutes. So we'll just keep it moving. Now we'll just go ahead and move on to the fund performance report with Mariner Wealth Advisors.
Randolph, thank you so much. Eric Toll here with Morgan Strange from Mariner. We're, as always, appreciative of the opportunity to present our quarterly report to the committee. I'll start by walking through briefly the updates, which from a Mariner standpoint simply amount to our continued growth and expansion, both on a local and national basis. We continue to add personnel within the Kentucky marketplace. We've made some general organizational changes that are more superficial from your standpoint, but that continues to be our growth. We continue to add locations throughout the country, which feeds into the local expertise. But our pride on page 5, the continued recognition nationally by publications such as Barron's that look at Mariner and the work that we're doing. And as long as the ranking has been in the running, we have been no worse than we've been in the top 10 every year, typically in the top 5, and we were ranked number 6 again this past year out of all registered investment advisors nationally. So something that we take great pride in, something that we have no influence in other than the service that we provide, and so we're always, as always, honored. Again, your local team here in Kentucky continues to expand and grow. Morgan is a valuable member of our team, expanding her role within our organization, so she is joining me here today. But all of us, in a form of one Mariner, are here to serve Lextran and are again very appreciative of the opportunity. Briefly, I'd like to take this opportunity just to point out, as allocations are important and diversification is important, that per the investment policy statement for Lextran, the general asset allocation range for cash is 0 to 10%, bonds is 20 to 50% with a target of 35%, and stocks have a allowable range of between 50 and 80%. With a target of roughly 60%. If there are any changes, whether to the ranges or individual inclusion, exclusion, I want just to remind the committee that we are open to that. If there's anything that you would like us to revise on the IPS, I believe the last revision was over a decade ago. So if that's something that you want to take a look at, we're happy to work with you on that as well. I will skip through the details of the IPS itself, and in the interest of time, come to page many pages. Sorry, 18, which is the beginning of the first tab. Just a overview both of how the 2025 having concluded, what the equity markets and fixed income markets look like on the aggregate, as well as specifically how Mariner had viewed it for last year. It will set the predicate for what we discuss in terms of our expectations for the current environment and going through 2026. So if we look at 2025, global equity returns were again exceptionally strong. The S&P was up another 18%, the Dow was up 15%, and the Russell 2000, which is the the index tracking small cap stocks itself was up 13%, which was a change. The domestic equity strength is not new. In fact, that's a continuation of a ongoing trend. What is new is that international stocks outperformed U.S. stocks for the first time in quite a while. Now, there's some context that's important around that. One is that most of that outperformance occurred in a very tight window around whether you call it tariff tantrums or Liberation Day. Most of the delta or the separation between U.S. and international stocks occurred right around that lead into April and immediately following April. From April through roughly November, U.S. stocks outperformed international, and then it reversed field again. But there was such a gap created early in the year that U.S. stocks never caught up, and there was a pretty big differential. The reason I bring that up is when we look at long-term trends and how we want to be allocated, it's important to not just look at the overarching, the 12-month number, but to understand kind of how we got there, and that we don't want to be chasing returns that or opportunities that may have already passed us by. Speaking of which, on page 19 is a review of Mariner's call on what the equity markets in 2025 were going to look like. Kind of like the Barron's, this is one opportunity for us to pat ourselves on the back a little bit. CAT stands for Clear Air Turbulence. For any of us who have flown frequently, we know we can be gliding along and there's no issues and no warning, and all of a sudden you drop a couple hundred feet and you wonder why. There are bumps that you don't see coming, and that was our prediction for 2025. Was that we had a S&P price target between 6,600 and 7,000, which is where we came in, and that there would be volatility. Not necessarily foreseen volatility along the way, and that's exactly what we saw. But to the point on the top left chart, what we see is that the equity markets in the early part, the first trimester of the year, were universally negative and universally significantly positive from April through year end. That is, there's always a reason, but it is not abnormal, which we'll cover at the back end of the performance. But that is precisely what we had anticipated, and we were very happy to say that we didn't adjust our price targets when everything else went haywire. We kept firm, and we're glad to see that the year ended as we had predicted. Page 20 is a reflection of what has been in the news, and we've talked about a number of times here before, whether you call it the Mag 7, please don't, because I'm about worn out on the term, or just the top 10 names in the S&P. Through the end of 2025, the S&P had become more and more concentrated to the point where nearly 40% of the market cap of the S&P 500 was in the top 10 names, which has a lot of implications for investment managers. If you want to outperform during that window, then you have to load up and have more weight in those top 10 names. If that is your short-term objective, and not wanting to take on that additional concentration risk means that you have to be okay with, at least for short periods of time or windows of time, underperforming the index. But the index is not our goal. Delivering on your objectives is our goal, and that's something that we are always mindful of. What's also interesting, if we ran this again today, it would not look like this. Already in the first 6 weeks of this year, we have seen a significant reversal. For anybody who pays attention to the markets and the news knows that tech has been trading down. And what's really interesting is that if you look through yesterday, that the equal weight S&P, which means you take all 500, it's actually 502, but who's counting, 500 names and provide an equal weighting to them all, that index through yesterday was up 5%, while the S&P was up a little over 1%. Now what that tells you is that people aren't leaving stocks, they're being discerning and saying, maybe Amazon's run up a little bit too much. Why don't we buy Caterpillar instead? And that is the type of trade that we have seen. So again, diversification is our friend, and not chasing what seems to be the one thing that's working is not favorable long-term investment dynamics. Page 21 reflects the current interest rate curve. This hasn't changed significantly since the last couple of times we've met. The curve has been steepening, meaning that rates on the longer end are higher than rates on the shorter end. As short-term rates come down, we anticipate you will continue to see some steepening of that curve. Where that settles in is less to do with Federal Reserve decisions, regardless of what the news will tell you, more to do with the market is telling you about the length and strength of the economy. But nonetheless, we do expect the continued normalization of the yield curve to continue. So with that, I'm going to take a pause. I'm going to let Morgan walk you through the Lextran portfolio summary, and then I'll come back and talk about the economic and future updates.
Great, so on page 22, we are looking at the portfolio summary of the plan. The top left, we see the asset classes in which the funds are allocated. 50% into large cap domestic stocks, so that is where we see the largest allocation. For a total of equities and alternatives of 74%, still within range as what Eric mentioned, but a little bit on the higher side of that range. With cash and fixed income making up 26% of the portfolio, putting off an estimated annual dividends and interest of over $515,000 for a rate of just under 2%. So what we like to see in that pie chart is a diversified pie chart, although large cap is a little bit larger, but that is not out of the norm. For performance, we look year to date, and this is through January. The total portfolio is up 1.3%, which is a blended rate of 0.3% for fixed income and 1.6% for equities and alternatives. 2025 is also there along with 2024. For 2025, portfolio was up 12.4% with a blended rate of fixed income being up 6.3% and equities and alternatives up 15.3%. So you can take a look at 2024 there as well. But on the 10-year average, the portfolio has averaged 10.3%, with fixed income being up 3.2% and the equities and alternatives being up 13.7%. And this amount at the bottom here is just showing the value in the equities being right under 20 million, the value in the bonds being right under 6 million, and cash at we'll say 1.3 million, for a total value of 27.2 million, let's say. On the next page, we look at the activity within the plan. So we've got 2024, 2025, and year to date. I'll let you guys take a look at 24 if you'd like. But for 2025, started out at 23.8 million with the cash flow, incoming, outgoing distributions, contributions, dividends, interest, bond accrual, and market fluctuation. We ended 2025 at 26.9, let's say, million. So we started January at that number, had a little bit of cash flow come out, dividends and interest have paid in, market value fluctuation, for where we ended January at 27.2 million, let's say. And the next page on 24, if I can get my paper to move. We have the individual equities. So this is going to be the active piece of the equity portfolio. On the left side, you have your higher income, lower risk, the growth and income stocks, as we like to point out. So these are going to be your high dividend growers or have a high dividend yield. One I will point out here, just looking at, is I'll pick on AbbVie, has a dividend yield of 3%, but also a 5-year dividend growth rate of 17%, which is quite nice, and a beta of 0.5, meaning that is about half the volatility of the index that it is measuring up against. So that's a nice one in that group. That middle group is going to be your cyclical growers. So these are going to kind of ebb and flow with where we are in the market and economic cycle. We will change these out with where we are in that cycle. One I'll pick on here is Citigroup. We've got a 12% earnings per share growth rate, but also only a 10 price to earning ratio. So that means this stock has a long way to grow. It's got a lot of potential. We feel like we're getting in at a good value. And on the right side, we've got our high growers, higher risk. These are going to be more of your kind of pure growth stock. Eric said not to say it, but think of the Mag 7 and some additional ones here. I'll take a look at, let's look at Google or Alphabet. Earnings per share growth of 18% and a PE of only 18. So this, while this is technically considered a Mag 7 stock, it's got a nice lower PE ratio, so we do see a lot of room to grow in that one. The next page is going to be our top 10 individual equity holdings. We do come out with NVIDIA being the highest percentage in the portfolio, right around 8%, with a market value of just over $1 million. Followed by a lot of those other large companies, Apple, Microsoft, Amazon, Google, Meta, Eli Lilly with some pharmaceuticals in there, Chase and Financials, Goldman Sachs, and Baker Hughes. The one thing I do want to point out here is that this is a very diversified chart, which is what we want to see. We don't want to see too much in any one particular stock. The next page on 26 is just kind of breaking that down into sector where those stocks fall. We do see the largest amount in the technology sector being right around 34%. This is kind of no surprise with where the market has taken us over the last few years. But again, want to point out that a diversified pie chart is what we're looking for here, which is what we do see. So a lot of amounts still allocated to financials, consumer discretionary, healthcare, industrials, communications, energy, and utilities there too.
One additional thing I'd point out here is, we see, and I always make note of this because I think it's important, that technology being nearly 35% of the overall is actually underweight the index. So we're not making any significant bets or calls against the overall index, that at least nothing that varies too wildly, because we're mindful of your risk tolerances and objectives, so we don't want to get out too far in anything. But whenever we see, for example, NVIDIA on the previous page at nearly 8% of the overall equity position, by the way, not overall portfolio, or technology at that 34%, just understand that is in line, or if anything, a little bit of a soft touch relative to what the overall index is doing, because we're looking to manage the risk there as well. Sorry. Go ahead.
No.
So since we had just a little break, Morgan, I'm sorry.
No, absolutely.
Moving back to page 23, is it typical for, if you look at 24, 25, and year to date, is it typical to see the 2.5, 3 million each year as far as growing? I mean, is that what we can look forward to in the future, is 2.5, 3 million as far as the growth?
Well, Jason, that's I hate to obfuscate, but there's a couple of things there. 2 million on a $27 million account isn't an enormous lift in a bull market. So I think that is, again, I would caution, just because we have been in such a run, if we wind up in a 5% equity market, that's going to feel bad, because we've been in such a stronger market, but nonetheless we're still performing. So as the fund continues to grow, then the absolute dollar as a percentage is lower, and it's easier to achieve. But obviously very cautious about level setting expectations, that we are always going to participate roughly in line with what the equity markets and bond market combo based on your IPS is going to allow, because we're never going to take such a big position to achieve oversized returns, because the risk of that obviously is worse than the benefit achieved. Does that make sense?
Yeah, I mean, basically what you're saying is, even though it's a slow growth,
Yeah. Right.
typically,
Yeah. Right.
it's still growing.
That's right.
Mm-hmm.
And that's what we like to see.
Yeah.
It's still growing. Now, if it doesn't grow, then that's a different
Yeah,
story.
it's another thing altogether. And I'll cover part of this too, obviously, on our expectations for this year. the last kind of caveat or piece I'd put in there is there's a reason why, while we have, based on the request and recommendation to have an active-passive combination, which we're fully in agreement with, but the active component is so important, because while we see, that's why I was highlighting the concentration at the end of 25, well, that's unwinding now. Well, if you're simply investing in passive strategies, you are being punished for that unwinding. If you are in active strategies and you've allocated beyond that makeup, then you're benefiting from that, and that's a very important component to maintain a all-weather or durable portfolio. And that's, again, what we're particularly for you, because this isn't art on the wall, right? This is investment money that is for use, that we want to make sure that is perpetually for use, and so we're taking a different investment approach than simply buying a combination of the S&P 500 and the bond ag, so to speak.
Thank you.
So we'll go to page 27 after talking about the sector allocation. As Eric mentioned, kind of the passive piece of the equity portfolio, that makes up about 32% of total equities. So we see here on the top our large cap funds. So we have our large cap growth fund and the value fund. I'll let you guys kind of take a look at the past 24, 23, and 22, but for 2025, the growth index was up 18.3%. The value fund, should I say, was up 15.7% for a blended rate of 17. Well, the S&P was up 17.9%. So we see year to date that the growth, as Eric mentioned earlier, is down a little bit, 1.6% down. But the value has taken a nice turn there, up 4.5% year to date, whereas the S&P is up 1.5%. So taking a look at the 10 years average that we've been in within these funds, the growth fund has averaged 18.4%, and the value fund has measured 11.4%, while the S&P has been 15.6%. Taking a look at the small mid-cap fund that we are in, so far year to date, it is up 5.5%. Again, we've kind of taken a nice turn where people are broadening out what they're being invested in, whereas that is measuring against the index at 5.4%. For 2025, that was up 12.7%, comparing to the index at 12.8, so almost right on target there. And the 10-year average of 11.1% versus the index average of 11.2%. So we're kind of spot on there. Looking at our international fund, so far year to date, up 4.9%, comparing to the index at 5.2%. Last year was up 31.6%, with the index up 31.9%, for a total 10-year average of roughly 9.4%, comparing to the index at 10.1%. So pretty close there too. And as Eric mentioned, it is important to be invested in these funds as well, as they make up kind of the passive remaining piece of the equity portfolio that we want to be invested in. And then lastly, taking a look at the bond review on page 28, we see here we have another pretty pie chart. You'll see the largest piece of bonds are going to be maturing in the 1 to 3 year, with just around 2.4 million there. The next largest group is going to be maturing within the 3 to 5 year range, around 1.2 million there. And we do have some short-term bonds maturing within the next year, around $970,000. Some longer term, 7 years and out, around $745,000, and then $500,000 within that 5 to 7 range. I will point out here, if we look down at the bottom, we have 25% of the bond allocation set to mature in 2027. With that, what we will do when those bonds do mature, we will reallocate those maturities into further out years to just keep the money invested and keep taking advantage of the rates where we do see them fit. So total market value, you'll just look at the bottom of the bonds in the portfolio, or right around, we'll say $5.9 million.
I would say there too, thank you, Morgan, that it would be my expectation with the steepening of the yield curve that you see a not an abandonment of the 1 to 3 year window, but more of a balance between the maturity tranches, as there's more value between 1 and 10 years than there has been recently. I mean, we're all familiar with where money market rates were post-COVID and short-term rates were, and it would have been foolish not to take advantage of that. But now, again, we're seeing those shorter-term rates continue to come down, albeit grudgingly, and the steepening of the curve means there's more value a little farther out. So I would anticipate a little bit more balance there. Before we move into the forward-looking, the economic and forward-looking, any other questions on the portfolio or anything that you'd like to particularly address? That's okay, I'll be here all week. So on page 30, U.S. gross domestic GDP, gross domestic product, continues to be strong. First quarter of 25 and second quarter of 25 are a bit of anomalies in terms of reporting, based largely on the impacts of tariffs and business reaction in anticipation and then after the fact. So we kind of discount those as just their noise rather than signal. But we have seen a firming and strength in GDP. And the components of gross domestic product are all looking positive from our standpoint, both now and at least into the near future. Those being the consumption drives the vast majority of GDP in this country, and consumption doesn't seem to be abating. Business fixed investment, I think CapEx. There's quite a bit of business spend that is going on out there, and then of course there's government spend, better, worse, or indifferent. The government spending doesn't seem to be taking a significant hit. So the drivers of GDP continue to move forward. We expect, or I would expect, that we'll see another significantly north of 4% positive print moving forward, and earnings suggest that will continue on through the year. At the same time, inflation concerns are subsiding, and really in my tenure here, we've had quite the roller coaster of inflation discussions. But one of the things that has kind of settled in is that we have seen inflation anchor between the 2 and 3% range. Now, we would love to see it get down. I know the Fed target is 2%. We all know the Fed target is 2%. But really somewhere between 2 and 3%, which is the long-term average, is fine, as long as it's well anchored, and it currently appears to be well anchored. The drivers of inflation continue to be shelter, as there is not enough homes or residence for everybody who wants it. Although there was an article in the Wall Street Journal just a couple of weeks ago where for the first time in a number of years, somewhere in the neighborhood of 69% of all homes were bought below the original listing price. And so it's become a buyer's market. We'll see if that trend continues. And there's actually been different markets, there's actually been a deflationary pressure in rents. But largely, if you don't need out a lot, if you already have your home, your inflation is in pretty good shape. But it is important, and sometimes I feel like I'm Don Quixote tilting at windmills, but to make sure that we understand that what is a primary driver of inflation is money supply. How much money is sloshing through the system has a large impact on inflation numbers. And so we see on page 32 that around COVID, when productivity was ground to a halt artificially, that the money supply was expanded artificially, and it is not coincidental that inflation peaked at the same time. And as the money supply has shrunk relative to the size of GDP, that inflation has come down. That is not coincidental, and I think that we'll continue to see that dynamic playing out in the inflationary system. So again, as productivity increases, which we've seen, the GDP grows, and the absolute money supply stays constant. As a percentage, it comes down. That inflation, the pressures are down. I thought this was probably a pretty good time to start talking about artificial intelligence and where the impact of AI is actually going to be, and where we're actually seeing that from an investment standpoint. You know, the automatic thought is AI is about tech, and it is. I mean, it is, especially in development. But as we're finding out, it can also have some drag effects on different areas of tech, like software, which now doesn't seem so important. If your AI can write the code to handle your software applications, you don't need to go spend $1 billion on Adobe, for example. You can do that in-house. But where we do see some significant impact of AI is actually on your brick and mortar and more traditional businesses, because they run at such lean margins that any incremental benefit in productivity at, say, General Motors, that maybe doesn't need 12, my wife was an engineer at GM when we first met, they don't need 12 of them on a job. When you don't need 12 full engineers doing something, maybe you need 10 of them or less, and a lot of the paperwork processing can be handled by AI. That's a significant impact on a company like General Motors' bottom line earnings. And so what we're seeing, and that's where the market has been telling you this first part of this year, is all the benefits of technological improvements in productivity are not necessarily accruing to tech. They're accruing to the tangible areas that AI can't replace, but it can enhance. And so that's where we're starting to see that real impact, and I'm excited to see that actually continue to ripple through the economy and a reorientation of that here, and that will be a continuing topic, hopefully replacing things like Meg. Page 34 is the always complicated and always important unemployment rate and wage growth. We would suggest that right now, while it is very complicated, certainly the employment market in a which is absolutely in a low hire, low fire environment, largely predicated or presaged at least by the ramp up in hiring around COVID, is I would say complicating the measurements of where unemployment is. But we are still well below the unemployment long-term trend rate at 5.5%, and wage growth, which is currently growing at 3.6%, is above the long-term average. And more importantly, wage growth is on top of, and significantly at this point, on top of inflation. Does that mean that it is that way for everybody everywhere? No, absolutely not. Kind of like housing. Some places rents are actually going down, some places they are absolutely not going down. But we are in the aggregate, this is what we're seeing. On page 35 is a discussion of the Fed and lowering rates. With all the noise and all the news, the absolute that you can take away is that we are in a Fed cutting or a lowering environment, not a raising environment. It's going to be a protracted environment, as the complications of the data make it very difficult for the Fed to make definitive decisions. But they're not raising rates, and the pressure and the trend is lower, and that has implications on both bond markets and equity markets. And so it's identifying that trend that's more important than what the absolute rate is. We're looking at the FOMC long-run projection to get down to roughly 3% from the 3.75 where we're sitting now, and we would largely agree with that. Page 36 is a chart of consumer and investor confidence, and this has been updated from recent iterations of this chart to show why it matters, because this is a counter-cyclical trend. In a moment, I'll talk about our fundamentals, valuations, and technical analysis on the market. And one of the things that's so important in here is sentiment. But sentiment is a contra-indicator of investment equity returns. When we see peaks in investor confidence and consumer confidence, that is normally followed by a lackluster or below trend equity market. Whereas if we see troughs of investor sentiment, meaning it's bottomed out, then that typically is a is a precursor for a strong equity return environment. And so this is, we are, I would say, somewhere kind of in between. We have hit a low, but we're not at the low. The examples I like to use for this, just to kind of frame it out of the statistics, is when people were buying NFTs and ape cards, that means that they have just found nothing solid to buy and they're just throwing money away, and eventually that's going to end poorly. When everybody's gotten out and you can get really good companies at cheap prices because everybody's so negative, that's a great time to get in, and you're likely on the precipice of a nice run. So we don't see NFTs being bought currently. The FVT, or fundamental valuations and technicals setup, that we utilize when we're evaluating the market for near and intermediate term trends, is everything is skewed neutral or positive. We don't have any outright negatives currently. In the fundamentals sections, the earnings are strong, interest rate trends are working for us, so everything from a fundamental standpoint looks neutral at worst to neutral positive at best. On the valuation standpoint, on the other hand, while we're still neutral, we aren't foolish enough to suggest that the equity markets are cheap. So we would put that at a neutral to slightly negative component. And then finally, on the technical side, again, the long-term trends are good. The individual sectors look strong. The only potential neutral negative in there is sentiment, in that, again, we have been on a multi-month run here, and it may get a little frothy, and seeing, candidly, what we have seen, a little bit of reevaluation of have these tech names run out too far too fast has taken place, and that's the sign of a healthy market, but not necessarily one that you want to apply new dollars into. And so we're kind of seeing that as it moves forward now. Page 38 is our coup de grace in every, is just a reminder, and I do have one slide after this, is just a reminder that, you know, the market, it is unusual for the market not to at least have a correction every year. On the other hand, it's also unusual for the market not to wind up positive nearly every year. So in the overwhelming majority of years, you have an average intra-year decline of over 14%. We expect it because it happens significantly more frequently than not. Last year, we actually got down more than 20% intraday, but on a closing day basis, we got down 19% there in the early spring, but still wound up significantly positive, and so we're used to that. So we're not short-term operators. We understand the ups and downs, and don't want to be foolish and ignore signs, but we also don't want to just blow with the wind. And then finally, I'll give our base case for 2026 and what we expect. And I would remind, we're on 3 years running of a strong equity market. There was some wonder before this came out a couple of weeks ago whether or not we were going to reverse course and look for a flat to negative year, but earnings just don't suggest that. And ultimately, the market is based on earnings and earnings expectations. Earnings continue to be strong. There may be a reevaluation or a re-rating of how far into the future we project those earnings on things like software. But overall, earnings continue to be exceptionally strong. So our base case, or 50% chance case this year, is for a 12% price return on the S&P 500. That is above market consensus slightly. If things go exceptionally well, we can see that bumping up to 18 to 19% return on the S&P, which would get us up to an S&P range of 8,100 by the end of the year. If it comes in as a disappointing case, if things don't materialize as we expect, if maybe AI spend is a little less than we had than had been anticipated, then we're looking at a flat year based on current earnings trend. And if things really roll over and the circular financing of data centers, for example, winds up being a real problem, then we can see nearly a bear market pullback in our operational model. So the way that I would frame this year is we have a very a positive outlook, not ignorant or blind to the concerns of the market. And relative to last year, we see a higher ceiling potential, but also a lower floor potential. But the base case is in that again that 12% range. So with that, I'm happy to answer any questions. Again, say thank you so much for your trust and partnership. And again, we're happy to answer any questions that you may have.
I do have one question because I'm just not sure what the number is. What are the yearly expenses? What is the payout, I should say, on the pension fund?
I don't have it in front of me, but I can get that for the committee.
I would love to see that. It's just because I'm always curious how much we are spending versus how much we're bringing in. And if we have any estimated growth on the expenditures and so on. Knowing how much we spend will give me an idea of how well we are doing investing.
Do we have any other questions? Thank you, Mr. Harris. Thank you, Morgan. Next item to discuss is old business. Do we have any old business? Any new business? Okay, that's easy. Next meeting is scheduled for May 19th, 2026. May 12th.
No, it was moved.
It was moved from May 12th. I apologize. Next meeting is scheduled for May 19th, 2026. If there is no further business to discuss, this meeting is adjourned. Thank you, everyone.
Thank you, Randall.